So, good afternoon, good morning, good evening, everyone, based on uh, your location. My name is Alok. I'm the moderator for the today's webinar on leveraging machine learning in banking. So, I welcome you all for this very interesting, thoughtful, and thought-provoking session today. Very quickly, I take the privilege to introduce the is our speaker and panelist today. Very accomplished panel we have today. Um, a quick introduction about me. So I'm Alok, co-founder of Aptiv and Cognext. We are a leading firm in the space of AI machine learning analytics, working with banks globally. As a firm, we have worked with close to 150 clients in 30 plus countries. That's a very quick introduction on me. We've got Neha with us today. Neha leads, she is the Chief Analytics and Data Officer for KIST. KIST is one of the leading FinTech in India, which offers seamless and instant credit at point of sales. KIST has so far raised close to $50 million, and they continue to grow at a rapid pace. Prior to KIST, Neha, I worked with another highly successful startup, Lando Eiffel. They were working on bringing alternative data sets and how it can be used by banking financial services. And before that, she was head of modeling and analytics at Sibyl, which is the largest credit bureau in India. So Neha brings an extraordinary combination of conventional as well as the new and emerging set of analytics and capabilities. And our second panelist is Nitin. So Nitin works at Credible. He is one of the founding member. He leads the product and technology. Credible is the market leader in India in the supply chain finance. Again, a very highly successful startup, raised over $20 million and continue to grow at a massive pace. Prior to um, Credible, Nitin spent time with Snapdeal, again, one of the very successful e-commerce platform in India. And before that, he had a stint with a large financial institution, Sun Life, which is in the space of insurance. And the our last panelist is Dinesh. Is my colleague, a known expert in the area of risk analytics and AI. Dinesh has advised and led large engagement, specifically on the MLAI transformation for banks across geographies. Uh, he's, oh, he brings together a deep expertise, again, both the conventional modeling for financial services and how that can be enhanced further using the machine learning AI techniques. So I welcome you all and thank you for being our panelist and speaker today. The agenda we like to cover today very quickly is first is a broad view on what are the trends in financial services and how the adoption taking place globally, and what are the challenges or success stories which are there, and how bank can play a catch-up game if they can. Um, the second session, which will be led by Neha, is on the showcasing some real life insights in the AI ML adoption in the digital lending space, followed by a session by Nitin, who will highlight how they have been using some of the emerging tech and analytics to create the best in class supply chain platform in India and the experience for customers. and Dinesh will highlight a few machine learning use cases in the consumer banking. And then we have kept towards the end a 25-minute session where we'll be happy to get answers from some of these panelists on your questions. So first and foremost, let me start and share our perspective, what we're seeing globally and what's happening. Um, so, what banks are interested in today finding out to discover what is next in terms of banking, and I'll for a moment take you away from banking because if we go to the next slide. When Amazon launched Amazon Go, the customers' reaction was magical. So, I saw a clip where they were interviewing customers, and some customers saying, "Oh, this is like a magic." And obviously, it's hard to believe that we'll be fortunate to get some reactions like this one day in banking, where our customer also say this is a magical experience. But what is clear here is in terms of the vision which Jeff Bezos has put, that it's a very simple statement. No one likes to wait in line. Instead, we imagined a store where you could walk and pick up what you wanted and leave. So this is pretty much defines the customer journey. A very simple journey, explained very simply, but the trick lies in making it happen, and that's what Amazon has achieved. If we go a step further and see where the Tesla is heading now, so they are very close to achieve level 5 autonomy, and which means it no longer require any driver input. And Elon Musk is uh, quite optimistic about achieving this by end of this year. And the point I wanted to raise is when we talk about Amazon, which is largely retail, or Tesla, which is in the automobile, the vision is clear, and there are market leaders who have set a very clear, demonstrable use of some of the most advanced machine learning AI algorithms and put in use, and customers have experience. When it comes to banking or financial services, it's somewhat not clear. It takes effort to read on this slide what a future bank look like. So whether a future bank look like Goldman Sachs Marcus, which is without any branch, mobilize more than 30 billion of deposits at a rapid pace. Last month, Marcus has launched transaction banking API, which means to do transaction banking, all you need an API. So whether that is the future model or whether it's Ant Financial, what is the future of a bank or a Google or Amazon, it's still not clear. Like as I mentioned, in retail and in automotive, it's very clear what a future retail looks like or what a future car looks like, and they're very close to achieving it. When it comes to banking and financial services, the journey is still not there. And that brings us to the next. Uh, so, what is happening on the AI ML adoption in banking? And I thought before I pick up some, key trends and challenges, it's good to do a 101 on AI and what is AI. And very simply put, it's AI can be defined as ability of machine to perform cognitive functions associated with human mind. So the number of things which a human mind can very intuitively perform. And one of them is taking decisions. And this is the crossroad today where the AI in bank is standing, because yeah, of course AI, there are algorithms which can take decisions, but uh, banking, as we know, is highly regulated industries. And when we talk about decisions, there are a number of human values which come into the decision making. The values around ethics, the values around explainability, defending a decision, explaining a decision. There are issues around bias. So that is what, in my view, currently AI in financial services is going through. And obviously, to do so, it does requare various capability and the number of use cases successfully experimented or delivered within banking financial, using range of machine learning AI capabilities from facial recognition to computer vision to natural language processing, smart robotics, virtual errand agents doing conversations based on the sentiments, or there are range of algorithm which do an autonomous function like underwriting or um, in the lending space. So now, having seen what AI means and what others industry has achieved, if we go to the next slide, please. Where is AI in financial services largely? So if you look at the start of this journey, which is largely experimental, and obviously the destination to create a AI first enterprise, that's the journey which every bank and financial services companies wish to take. I would say at the moment we are not even midway. We are somewhat slightly ahead of the experimental stage, having seen few success in the industry. But I think in terms of the maturity, there's a long way to go. And this journey obviously involves unlocking a massive potential for the industry. A recent note by McKinsey estimates that banks and financial services companies using AI can unlock close to $1 trillion of incremental value. So that is what is at the stake, and so in this journey, where are the use cases? So we have seen use cases where you can just smile and you know initiate a transaction or conclude a transaction. We have seen range of automated underwriting capabilities using micro expressions to sentiments to automated algorithms, and creating virtual loan officers which can underwrite and approve a loan. We are, I think, the third point on the biometrics, where voice, video, print has seen, I would say, is the one area where banking has come close to an industrial scale adoption. And this is now widely used on onboarding customers, doing KYCs, and which is becoming industrial scale adoption and success in banking. Then machine learning to detect fraud, cybersecurity attacks, again massively, rapidly growing area, seeing a lot of success globally. So that is an area where one can say that journey is fairly mature. Then conversational bots for basic servicing requests, either through chat or through other means. And again, seen some success globally. Most recent being by WhatsApp, banking on WhatsApp, launched by largest private sector bank in India, which saw over 1 million customers signing up within 3 months. So again, very good benchmark. Humanoid robots in branches to serve customers. I mean, the Citibank and few large banks have tried it, especially for their ultra net worth and high net worth customers. They have come out with few branches and tried to experiment the customer experience here. Rapidly increasing use of machine vision and natural language processing to scan and process documents. So this is again a area we are seeing large adoption where banks are reading the financial statements or the customer bank statements and all lot of other information and analyzing it and using it for credit decisioning or monitoring covenants on loans or monitoring the bid guarantee terms. So that is an area again seeing very rapid adoption. And obviously the real time transaction and risk monitoring using graph computing and other concepts in the machine learning fraud AML area. On an average, among the large financial institutions globally, they have done about 5 to 7 use cases. Some of the largest financial institutions have done over 25 plus use cases identified and experimented, run pilots, POCs, and adopt. So that has been the the wide spectrum of adoption. If you look in financial services now, where are the challenges in this journey? So if we go to the next slide, please. The challenges, first and foremost, there are some surprises here. Uh, Contrary to common belief, based on number of surveys, and you can refer these surveys online. Most recent conducted in by 2019, the Prudential Regulatory Authority and Financial Conduct Authority in UK. Then there's a EIU survey, a European survey. Regulation is not seen as a barrier at all, and this is a surprise for me, and because all of us know what happened to Ant Financial recent IPO, and at the last stage it was put on hold because regulators wanted Ant Financial to comply with some banking regulations. So, but based on the survey, it's not seen as an investment. The second surprise is that the biggest barrier seen across all these surveys cost. So most banks and financial services companies think that it's incredibly expensive to adopt AI. And why is it expensive? Not purely because of the adoption of new tech on platform, because they are deeply tied in legacy systems, and the way they manage data within financial services institution is spread across multiple sources and multiple data stores. Is would require huge transformation for them to fully leverage the AI ML capabilities. So until unless they go re-architect themselves on AI first principle, they'll not be able to fully utilize the capabilities and the investment they make. The other key consideration or challenges, one is moving from a human centered to judgment centered. So as I mentioned earlier, as you move more in the decisioning area, you will get more challenges from consumer, customers, regulators, and other stakeholders. And that would require you to put a comprehensive model risk management framework within the institution, because if a model or an algorithm is actually taking decisions, then you got to prove to everyone that how that is governed, and make sure that those decisions can be explained, and more importantly, those decisions do not contain any biases or have any ethical issues around it. So these are the challenges, which banking financial services is looking to overcome for a successful adoption. And so how do we start the journey? So how do we overcome some of these challenges and make sure we successfully uh, adopt AI? So if you go to the next slide, please. So that is why we are here today, to share with you how to successfully use AI to deliver tangible business benefits. And in my view, nothing better than hearing real life practitioner who have made it happen. So I would like to welcome Neha to take us through what they have achieved and what were the key ingredients of achieving it successful. So Neha, over to you.
Thanks, Alok. Um, in my experience, the fintech and challenger banks are much faster than traditional banks in terms of innovation and adoption of AI. So, and this particularly becomes relevant for model deployment and deployment lifecycle. Also, when in a typical fintech, the integration with any third party is much faster and smoother. So let me quickly take you through the digital lending lifecycle at a typical fintech, right? The pipeline will usually start with user uploading his KYC document, clicking a picture, taking a video. And at this point, the user will also give you permissions covering your the SMS, call log, location data, etc. So in the background of what the customer experiences are couple of AI algos that run face verification, age, gender verification, and customer liveness check. Once a customer is onboarded, you get into a detailed income and risk profiling of the customer. I will take you through this particular point of detailed risk profiling in the next slide. Underwriting is typically done using a series of policy rules and scoring models. Post sanction, you would typically use collection model for optimization. Vipur, can you move to the next slide? See, the one of the major differences between a traditional bank and a fintech would be the kind of data one has access to. In a typical bank, you would see bureau data, demogs, repayment data coming in picture when you are trying to decide on a customer application. But in a fintech, you have access to alternate data through his phones, which gives you a truly 360-degree view of the customer. What customer is buying, what is his delinquency behavior, lifestyle, spending behavior. So it's a high dimensional data, and it provides a 360-degree view of the customer. See, the first part of collecting data, having it somewhere on some server is the easiest part. Next comes what differentiates you once you have the data. This this is the step that sometime last year we had put organizational prowess behind this piece. That let's spend some good 2-3 months creating whatever we can think of, right? Let's create a feature store which will cover your bureau and your SMS data. So what we ended up creating is a huge set of feature store, which we keep enhancing on a monthly basis. So one of the uh, key KRA of my data scientist is to come up with predictive features. So once the data is right, what it does to your ecosystem is that any model that you want to create and deploy becomes a 15-day cycle. What I have seen in bureaus and traditional banks is that even one cutoff change would take weeks. Somebody in the risk would ask for a change, then IT would go through the change. But because it is on cloud and it is uh, governed by one single team. The whole life cycle is much shorter. So ML ops works very closely with the data science team, and this is where largely all the changes from creation to deployment of the model happens. Any change that is required by the business is done between these two teams. So since it is fast moving data, and the scale of operations is huge, we tend to monitor, we have dashboards monitoring all the APIs that are hit in the full life cycle, wherever. So we know in real time where any of the APIs is breaking for us to make a correction there. So all the model monitoring from a performance and from proportion standpoint is done on a daily basis. Of course, the model going live most recently is, it gets disproportionate attention from us, but otherwise we generally tend to look at, the first, I mean, the SOP of the day. This is how it moves. You get up in the morning and you see the dashboards, and then you go about your work during the day. And the whole process of credit underwriting is fairly iterative. As soon as we see the shift in our through the door data, the entire model dev cycle is reinitiated. So when we resumed the business post COVID, it took us 10 days to redo our underwriting models and the refresh the cutoffs. And I said, I mean, I cannot say it enough. Having a feature store helps us to initiate this cycle directly from the modeling stage. I think I've largely covered the slides. I would be happy to take any queries that any of you has at the end. Nitin, over to you.
Thanks, Neha. So, Vipul, would you give me the access so that I can share my screen? All right, got it. All right, is the presentation visible?
Yeah, Nitin, it is. I think you'll have to just put it on full screen mode because.
Do you see the presenter mode?
Yeah.
How about now?
Yeah. Now it's okay.
All right. Great. So thanks everyone. I think great hearing Alok and Neha's thoughts in terms of what everybody has been doing in the machine learning space. Today, what I'll do is I'll talk about what we have been doing at Credible, especially in terms of machine learning, and I'll try to capture a few of the use cases that we have solved with the help of machine learning. So my name is Nitin Sharma, and I head product and technology at Credible. One sec. All right. So I think before we get quickly into the machine learning use case, I first wanted to give you a brief in terms of what Credible does, so that you have a better context in terms of uh, what is the actual implication of utilizing a machine learning model in a supply chain finance context. So Credible is a supply chain finance technology company, and we provide liquidity programs for enterprise supply chains. Now, what that means is typically right from the stage of a PO is being raised till the point an invoice is approved and paid out. For the full cycle, we have a variety of products that help large corporate anchors to fund their suppliers and their dealer distributors at scale. And so we have, as I mentioned, we have separate technology products to solve each of these use cases. But at the same time, we typically provide an end-to-end experience to our large corporate anchors. And typically, our large corporate anchors are A-rated and above customers, and we work in a variety of domains. So we are currently active in e-commerce, in FMCG, media, and several other industries. So the overall, we actually cover a broad spectrum of domains, and that's how we actually get a lot of data also, which is very varied in the structure. Broadly, these are the products that we have. So the first one, which is early payment program for the suppliers of large corporate anchors, and the third one, if you see on the screen, which is distributor funding program. These are the two flagship products that we have, and these are the two products that we first started with about 3 years back. So we are a very young firm, only 3 years into the existence right now. And so what these two programs typically do is these would provide a large scale financing solution to the suppliers and also to the dealers and distributors. So typically, whenever these suppliers or dealer distributors work with large corporate anchors, there would be a credit period in place. So whatever a supplier would supply, whether it is a good or a service to the corporate anchor, when the corporate anchor pays them out, there is a credit period involved, and that actually puts some kind of pressure on the working capital cycle of these suppliers. And then that is where we actually pitch in to provide financing to these suppliers and dealer distributors. The product in the middle, the second one, is just-in-time financing program. Now, this product is very unique. I think you won't hear a lot of fintechs talking about such kind of a product, because this is a product where we actually capture a billable event. So even before a particular supplier or say a dealer distributor has actually raised an invoice to the corporate anchor, even before that stage, we try to identify a billable event. Now, this billable event could be anything. So, for example, in case of goods being delivered from supplier to the corporate anchor, these billable events will be when the goods arrived at the warehouse. So that goods acceptance note, that event, when that is captured in the ERP system, that is something we capture. And it could also be, I think, in what we have done in the media spaces, as soon as a particular show goes live uh, on the television, that is also considered as a billable event. So rather than waiting for an invoice to be raised, we actually fund these suppliers right at the point of the billable event itself. I have a more detailed use case at the end that I'll walk you through. The last product is Cashable, which is our salary advances product. This is a relatively newer product that we have recently launched, and we're working with about 4 corporates on this particular product. So in terms of getting into the machine learning use cases, broadly, I'll cover 3 use cases. The first one is where how do we actually price these suppliers? So I'll take the supplier early payment program or the receivables exchange product as an example for explaining these use cases. So the first one talks about how do you price these suppliers. So there is a credit assessment model that we have built in terms of pricing these suppliers. The second use case is around fraud detection in terms of how do you capture and identify any transactional risk that exists on your platform. So we do a lot of transactions on our platform today. I think we have touched a scale where we're doing thousands of transactions in a particular day. So how do you actually automate that, and how do you capture any kind of fraud that might be happening in the platform? And the third is, which is very interesting actually. So this is something which would give you a sense of how an alternate lending avenue can actually be created with the help of machine learning. So utilizing the machine learning power, you can actually create new business models. So that is something we'll talk about. So I'll start with the first one, which is how do you optimally price a supplier on the receivables exchange platform of Credible? So this is the use case that we had, the problem statement that we have in hand. And when I say we want to optimally price a vendor, I mean that we want to price a vendor. So we do not actually want to misuse the power that we have in our hands. So we typically want to price a particular loan to a vendor which is very close to their bankable rate. Okay, so if the same vendor was supposed to, or if the same supplier was supposed to go to a bank, at what rate of interest the vendor will get it. So we actually try to predict that particular rate through this model. So about 3 years back, when we started working on this model, this is how it looked like. So since this is a proprietary model, of course, I won't be sharing all the parameters here, but there are about 100 such parameters which we typically take into account. Broadly, if you look at it, there are 3 broad categories in which these parameters can actually be categorized. The first one is the external rating parameter. This could be any rating agency that might have rated that particular supplier or that particular company. The second one is the financial parameters of these suppliers. All this information is typically taken from their bank statement, can be taken from their financial statements, whatever is easily available. Some of the parameters in the financial parameters could be something like a debt to EBITDA ratio that we take into account while we actually created this model. And the final one is the business parameter, that uh, how long the relationship between a supplier and the corporate anchor has been, and how long the supplier has been into the business overall. So number of years in the business is again one such example among others that we typically use. Now, when we started about 3 years back, it was typically a management gut feel that we gave as a weightage to each of these parameters. But over the last 3 years, now we actually work with thousands of suppliers of, as I mentioned, a wide variety of corporate anchors. So we gathered so much of data from these suppliers, and we also observed that there was at times a difference between what the model was suggesting as an expected rate for a particular supplier versus the actual rate on which we actually closed a particular supplier. Now, in some of the cases, the model was actually under projecting the rate, because we realized that when we actually had some of the suppliers for which the corporate payments were delayed later, when we had actually already started operations with them. And that's where we understood that the model is actually under projecting a particular rate. We should have actually done added some more risk premium to this particular rate for the supplier. And in other cases, it used to go other way around also, wherein the model was projecting a higher rate while the supplier had a really good, a very fine rate from one of their existing bankers. Now, but we kept on putting that feedback back into our model, and we actually ran a regression, and it's a constantly running regression that we keep on evaluating. And it actually gave us a lot of insights in terms of what exactly should be the weightages of each of the parameters that we have taken into account in the business model. Some of the, I think, insights, again, I would not be able to share everything here, but uh, the years in business, the as a parameter that I talked about initially seemed to be something which we wanted to give a lot of weightage to, but eventually, after having thousands of suppliers and lakhs of invoices, once we processed all that information, we realized maybe the years in business was not that statistically significant parameter to be considered. Another thing, when we started adding more and more industries into our equation, we also understood that an industry score was also very important when you are actually building such kind of a model. So uh, the industry to which a supplier belongs to and the industry to which a corporate anchor belongs to. Now, after doing all of this, we have actually reached a stage where this model has become self-sufficient. And I think, as Neha said, we also evaluate this on a daily basis. We identify how the model has been working. We iterate over the model constantly. But this is how it looks. When a supplier comes onto our platform, these are the three offers which are automatically generated for the supplier for early payment. And the engine behind these offers is nothing but the regression model that has been built. Okay, quickly moving on to the second use case, it's about the anomaly detection model that we have built for fraud detection on our platform. Again, thousands of transactions happen on our platform on a daily basis. It is practically impossible for our risk operations team to monitor each and every transaction. So what we have done is, and I think Alok has a big contribution here, because Aptiva was one of our consultants when we were building this risk assessment model for Credible. So there are about 60 plus parameters which we typically capture and assess at various stages of the transaction, and any kind of anomalous behavior is captured. So whenever you are onboarding a supplier, or when at the time of when a supplier is requesting for an early payment, or when the payment is being made to the supplier, a lot of things are typically checked. And some of the things I've mentioned here for, so that it gives you some idea that what ideally should be checked in such kind of a model. So for example, if you have a supplier, and we have seen several good results out of this particular check itself, that if you have a supplier who is, let's say, doing a crore of billing with a particular corporate anchor per month, but suddenly you see that one fine day you see a 5 crore invoice for that particular supplier against that corporate anchor. So that is clearly an anomalous behavior, and you know that something is going different than the standard behavior. Next is, what is the overall transaction time that is taken by a supplier to fund their transaction. Typically, what we have observed is, when the supplier comes onto our platform to fund one single invoice, it takes about 4 minutes or so. But let's say if you have a transaction which was completed in only, let's say, under 30 seconds, that calls for some audit of that particular transaction, because there might be a malicious bot which is trying to place such kind of a transaction here, or there could be some kind of collusion risk also, which you are not able to detect just by looking at a high level data. So that's where I think these anomaly detection techniques have actually helped us in terms of building a very robust system which throws automatic alerts, which can then later be reviewed by a risk operations team. um, and in terms of the techniques, I think standard anomaly detection techniques like monitoring a standard deviation over a time series data is something which you can utilize as a simple technique, or can go for advanced techniques as well. The final case I wanted to discuss is about an alternate lending business model that I believe was never possible without the machine learning as a technology. Uh, so this is a very specific use case that we solved in the logistics sector. So I'll give you an example. What typically happens in logistics sector is if you are an operator to a large corporate anchor. So I'm not talking about Olas and Ubers of the world here, but I'm talking about other, let's say, truck operators or cab operators who are working with large corporates or large enterprises. Typically their trips are running on a daily basis, while they get paid out either in a fortnightly basis or in a monthly, or even higher in some of the cases what we saw. So what we wanted was, can we fund these trips in near real time? The moment a trip is completed, can we make the payment in the accounts of the drivers or in the accounts of those operators, who, in case of if you have aggregated cabs and trucks. Now the biggest problem here was, how do you identify that whether a trip is a legit trip, or it could be a fraudulent trip, or whether a trip is fundable or non-fundable. So that is where we ended up with a classification problem that we solved with the help of a support vector machine. So this was the primary tool that we utilized. So this is a mobile app that we deployed at several locations where drivers used to start and end the trip on their mobile phone, and we used to capture a lot of information from their mobile phone. GPS pings to our server being the most critical ones, but apart from that, we also captured information in terms of whether the phone is connected to a charger, what is the battery level information overall through the overall trip, and other information as well. So since we had all the GPS information, we could also actually plot the full trip in near real time, that how what trip was actually taken by the driver. um, and finally, to actually identify in terms of the classification problem, whether can you fund this trip or can you not fund this trip, we built a supervised machine learning model, which took a lot of inputs as a parameter. Initially, what we saw, there were a lot of trips which where the system was not able to take a call. So it was not that they were all of them were fraudulent or all of them were invalid, but system initially did not have such data just to take a call. So system was not sure. But eventually, I think as in when we got more and more data, all the trips which are not getting approved automatically were sent to our risk operations team. They monitored those and either marked them as valid or invalid. That actually trained the model really well. Now some of the examples I'll just take quickly here. What important parameters were taken in the model? So one of them was what is the overall average kilometers that are taken between point A and point B for the end trips that are done by a lot of drivers. Now you might say that why can't you just take this information from Google's APIs? So we did that initially. So if you want to calculate distance between point A and point B, you refer to Google APIs and calculate that distance. But the issue is, there are a lot of drivers, or there are a lot of places where Google does not throw an optimal route. So we ended up with trips where the drivers were not following the trip, were not following the route which was suggested by Google. Instead, they were taking a separate route altogether to reach point B from point A. But eventually, when the model understood that there is a large sector of a large percentage of drivers who are doing this kind of a behavior, then it understood that this actually is a legit trip, and this may not be a invalid trip. Other things were, what is the ratio of the GPS location packets that were received on our server to the distance. So typically in our experience, 1 kilometer typically translates to about 60 TCP packets. I'm going a little technical here, but 60 times typically mobile app pings on your server. Anytime you have that, a lot of variation in this number, let's say the driver app says that it traveled for 1 kilometer while you only got 5 pings in that period, then you know that there might be something wrong in that particular trip. So I won't get, in interest of time, I won't get into each and every detail here, but these are some of the key elements which actually helped us in terms of tweaking the overall model. But now if you look at this, I think something like this would never have been possible if you wanted to do this either manually or even if without the help of the machine learning techniques that are available today. Typical rollouts for this mobile app was something like this. Initially, whenever we started at a given location, only 42% of the trips were actually approved by system. For rest of the percentage, the system was not sure how to answer. And but typically what we have seen is by month 3, the model learns a lot of data about the particular city or about a particular place, and that number reaches out to as high as 72% getting approved automatically, and the rest are something which has to be still audited, that whether you want to fund them or no. So that's all I think from my side. I'll hand it over to Dinesh, but hopefully I could pass on some information and could trigger some interest for all of you in the machine learning space. Thanks.
Thanks, Nitin. Hi, everyone. This is Dinesh. So, before I begin, it would be nice to check if I'm perfectly audible to everyone.
Yeah, Nitin, can you pass on the host control back to me?
Yeah, I'm trying to do that. How do you do it?
So you go to the participants list, just right click and make me host so that I can share the slides.
Yeah, let me do that. Did you get it?
Thanks.
Thanks, Vibhav. So before I go into details of application of AI/ML for consumer banking, let me give you a slight overview of the different classes of algorithms that we have today. The idea I want to highlight the differences at the algorithm level is because when I go into details, you will see that the industry adoption and the challenges that the industry faces, these are very different for different classes of algorithms. So, I think Alok initially touched upon on what is AI and ML. So, typically, when we talk of artificial intelligence, it is anything which has some cognition, but that cognition can come also from rule-based algorithm. So what is happening today is more adoption of deep learning and other machine learning algorithm, where humans are not configuring the rules. They are simply giving some input data and some output data in case it is supervised learning, and they are asking the machine to do the mapping between the input and the output and to figure out how to make the prediction. Now, if we see the most common class of algorithms that we see being used in the industry historically as well, that is when we are dealing with structured data. Now, you will see that, and this is the class where your linear regression, logistic regression, and your, let's say, tree-based algorithms, they belong to. When we are dealing with structured data, typically the dimensionality of data uh, is not huge. So we can actually use algorithm which has lower model capacity. And the typical use cases would be building a credit scorecard, let's say a collection scorecard, or let's say for anomaly detection. These are also the algorithms for which, as I'll showcase later on, we will see that over time, we will find that we will have the least amount of staff shortage. And typically, these are the algorithm which would largely be handled in-house for the simple reason that because these are being used in the industry for last many years, so that knowledge to handle these algorithm exists. Okay? Only what is happening is that the data sources are changing. So as Neha highlighted earlier, Earlier, let's say we were building a credit scorecard using a bureau data and internal data. Now a new dimension has come to the data side, which is alternate data. But as far as the data structure is concerned and the people who are needed to work on this type of data, that skill set is there. The second class is the machine vision algorithm. For instance, a convolutional neural network would belong to this class. These are the algorithms which deal with image or video as an input. Okay, and the typical use cases on the consumer banking side you will see is one-to-one face verification, one-to-n face identification. On digital lending side, age, gender verification as compared to the KYC ID. Anomaly detection as far as videos are concerned, to know whether somebody has created a fake video or not. And other use cases would be like text recognition from images. Typically, these are the set of algorithms which you will find require millions of data points. Okay, and therefore it is very difficult that we would see these being developed in-house by banks and fintechs. Okay, so typically they will rely on external vendors, and typically those would be like Google or AWS or Azure, because they have access to that kind of data to build those models. So just to contrast with the structured data, where I said most of these would be over time would be handled in-house, machine vision, we will see that they will become more and more of commodity. And at some point in time, banks and fintechs will have to look for external vendors only. Because if I have to talk in parlance of deep learning, you will not see many pre-trained models which are available in the market. And you will also not have access to that kind of data to build your own model. The last set of algorithms are typically the NLP algorithms. Okay, these are the algorithms which deal with textual data. Okay, so for instance, algorithm for machine translation, chatbots, question answering, language generation, where we can automatically generate reports on basis of data. And embeddings, really important use case, which I'll talk about later. These set of algorithms, as far as banking and fintechs are concerned, we will see that they will fall somewhere between structured data and machine vision. So part of this would be in-house, and a part would be taken from the pre-trained model, which have already been available in the industry. So what we will see banks and fintechs doing is, let's say, they take a pre-trained model and fine-tune it as per their data. Okay, so NLP typically will fall somewhere between structured data and machine vision. So we also have some use cases which combine these set of algorithms. So for instance, a speech to text. Okay, here the input would be audio or let's say video. The output would be the transcript of that speech. Now, typically, the use case in consumer banking would be that in case the call center has large number of interaction with the customer, you would like to do some kind of audio analytics on that, not only from compliance perspective in terms of whether certain keywords were spoken during that call, but also to derive features out of that. Okay, so for instance, you can identify features related to the tone of the customer, which then you can incorporate, let's say, in your collection scorecard. So typically, if I have to, in terms of in-house expertise needed, that would be easiest to get today for structured data, and would be most difficult to get for, let's say, NLP. In terms of data set, it would be very difficult to get data set for a machine vision task because the quantum of data set that is required is huge. Can we move to the next slide? Yeah. So let me talk about the ML use cases for consumer bank. So, first would be set of use cases for digital lending, and Neha alluded to these earlier. So let's say we have to automate the digital lending pipeline for a bank or a fintech. So typical use cases would be once the customer uploads the KYC document, you would require to run some kind of text recognition algorithm, a case for machine vision algorithm, where you would like to read and digitize that information automatically. This will ensure that there is absolutely no physical interaction needed with the customer. And these are the type of banks which can go totally branch, they can operate without any branches. The second use case would again be on the KYC and fraud detection, where typically you'll be using machine vision for, let's say, age invariant face verification, customer liveness check, etc. And the last set of algorithm where that is still not, I would say, it has not matured to that extent, and lot of groundwork is still happening. It is how do we derive features and information from the borrower interconnectedness. So if I know from, let's say, alternate data that these 10 people are somehow connected to each other on basis of their interactions, how can I use that information as part of my traditional model? Okay, so that is something on which we will see. Of course, many big banks are using graph theory and network analysis to identify frauds on the AML side, but it has still not come to, let's say, to the traditional credit scoring use case. That is something which is fairly exciting, and we might see more use of network analysis for that in future. The second is use cases, the typical scorecard building. The scorecard could be for income estimation, for risk scoring, for prioritizing collection, marketing, and also for personalizing your offering to your customer, how to recommend something to your customer. Also, the classic econometrics model, they also fall under AI. And the typical use cases would be, how do you build a time series model for estimating portfolio provision, for instance, let's say under IFRS guidelines. But because of the constraint on the HR side, and because of non-availability of resources which are, let's say, experts on NLP or machine vision, what we foresee is that a lot of focus will also go on the automation side. We would see banks and fintechs putting money and time to use AutoML software. That is simply because there is dearth of data scientists in the industry. We will see that the typical use for data science and data scientists, and people typical use for people in the entire model life cycle would in future be limited to data wrangling part and feature building part. So as Neha highlighted earlier, that, there are people in their team which are totally focused on building and identifying new features from data. So over time, what might happen is that the involvement of people is restricted to the feature engineering stage, and all the other stages of model lifecycle, for instance, the identify which algorithm is fitting your data well, how to tune that algorithm to your data, doing all the ML operations part, which is maintaining all the artifacts in a system, tracking all your model outputs. That would be handled by AI systems in future. The second growing use case, which we might see over the next couple of years, is in the BI part, the dashboarding part, to a large extent be relegated to the machine. There is already lots of work going on towards text to query language, where the business people, they can simply type what is the information that they need, and the machine will convert it into a query language, will query your DB and give you a nice looking chart or a table. So over time, and this is not restricted to consumer banking, over time in financial institution, we might see more use of automated BI as well. Customer call analytics, this, as I said earlier, this the huge data set residing with all the banks and still not being used for any predictive purpose. Largely, it is just being used for compliance purpose. So over time, we might see that all the customer calls, let's say, are getting transcribed by machine, and all the other features are also extracted from that information. Then those features can become a part of, let's say, a collection scorecard. And the last part would be, and a few banks have already started doing that, how to analyze, let's say, customer feedback about their apps and their offerings. Uh, the differences might be that banks are already using some kind of sentiment analysis algorithm to do that. Uh, these might just become more powerful in the sense that we might be seeing use of aspect sentiment analysis, uh, where if in a single sentence a customer has given some negative feedback as well as positive feedback, instead of being forced to classify the entire sentence as negative or positive, we might see that the machine is able to highlight that these are the parts which were positive and these are the parts which were negative. So automation is one area where we believe that the next focus of AI and ML would be. And these are also the part where a lot of work can be done in-house by the bank, okay, because these are not machine vision tasks. Yeah, Vibhor, next slide, please. Yeah. So let me quickly speak about what are the benefits we believe will accrue to the consumer banks and to the lenders uh, because of more adoption of AI ML. What are the current issues that we are seeing in the industry, and what are the challenges in adoption? So the most important benefit would obviously be on the business side. As Nitin also highlighted, the use of these algorithms will open up avenues to target new segment of customers, which were hitherto not possible because of the traditional ways of doing business. This is also because of better operational efficiency. You will see that your cost footprint will reduce because of using AI/ML. For instance, let's say if I am a consumer bank and I have to uh, automate a part of my lending pipeline, what I can do is I can digitize the bank statements given by my consumer and do analysis on those bank statement automatically instead of some manual underwriter doing that for me. So what that will do is it will reduce not only your TAT, but it will also reduce your cost footprint, and that will allow you to enter into new market segments. So, for instance, using more of digital lending pipeline, what you can do is you can focus on even short tenor and small ticket loans or cash flow based loans, which we are seeing the case for SME lending in India right now. Obviously, within the ML spectrum, if you change to advanced algorithm, you will see that you will derive more business benefit from that because of the additional lift they get you in model performance. And over time, we will also see that banks are able to personalize their offering better as compared to in respect to the customers they are looking for. What are the current issues which are hindrance to adoption of the non-traditional ML techniques in the industry? The first is obviously related to user privacy. So for instance, even if the industry knows that they can get additional lift in credit scoring models from usage of alternate data, there are user privacy issues. You have to get user permission for accessing that type of data from the device. And that is typically difficult for traditional banks, which carry more reputational risk, let's say, as compared to a fintech. The second part is related to model explainability and transparency. Now, typically, you'll see that a neural net or let's say a tree-based algorithm is not as transparent as, let's say, a regression model. In case of regression model, I can see the coefficient. I know how important each variable is. but that transparency erodes as we move towards more complex algorithm. Though a lot of work is going in the industry right now, and to a large extent today, as we stand today, these models are much more explainable and transparent than they were, let's say, 2 to 3 years back. We have algorithms like SHAP, we have algorithms like surrogate model or using Lime, and we can make these algorithms more transparent. The next difficulty might be, and this is typical to certain jurisdiction where uh, the lenders have to prove to regulator that models are fair to by different demographic cuts, and they do not show bias in favor of, let's say, a specific race or religion or gender. Now, again, we are seeing that a lot of work is going in this direction, and over time we would see that AI is not only more predictive, it will also tend to be more transparent and unbiased. But that is still work in progress. Another thing that we need to understand is that some of the algorithms, they have some type of biases to certain type of inputs. And therefore, you might see even model misspecification issues. Okay. So, for instance, in case you use a an algorithm with higher model capacity on simpler data. So, for instance, if you use neural network on your simple tabular data, which is not high dimensional, might actually erode the predictive power. So, it is very important to know that what type of algorithm you are. When I said predictive power erosion, it is typically on real time out of sample data set. Okay. So you might see that those algorithm misspecification errors might increase when we move from simpler algorithm to advanced. And the last part, which Alok highlighted earlier, that over time, once we see that banks and fintechs, they are adopting more of AI and ML, the traditional model risk framework might no longer be applicable to these algorithms. This is because model risk, we have to see that models are conceptually sound. We understand the input, the connection between the input and output perfectly. And we are also able to do that for vendor models. Now, as I said earlier, let's say machine vision, this will totally might go the vendor way. Okay, we might totally outsource it. Now, in that case, the vendors might not be willing to share the details of those algorithms to the same extent which the regulator insists. We might see a lot of work around model risk framework as well. As far as our traditional banking is concerned, we might see complete overhaul of the model risk framework. Now, what are the on-ground challenges in adoption? So what I highlighted were largely at the algorithm level. But on ground, what are the issues that we are seeing? First is obviously insufficient data. Uh, let's say even a simple use case like credit scoring, not all financial institutions have access to alternate data because of any number of reasons. Similarly, for certain type of algorithm like machine vision, which I highlighted earlier, the quantum of data, annotated data that you need is difficult to come by. So, and it is not possible for each institution to invest in that type of uh, data building exercise on their own. For instance, as Nitin highlighted earlier, for the SVM, the algorithm is improving over time as they are collecting more and more data and annotating that. So that would be the case for certain type of algorithm where you can in-house create your data set and improve your models over time. But for certain type of algorithm, data might not be possible to come by altogether. Second is insufficient talent, and this would typically be the use case for advanced algorithm. Let's say if I have to say about the Indian industry, you will see a lot of talent around handling structured data using traditional algorithm. But as soon as you venture into high dimensional data or unstructured data, and you are dealing with more complex algorithm like neural networks, you will see that the talent is difficult to come by. So that will remain a constraint, an operational constraint as far as AI ML adoption is in few markets. The third part is legacy systems are still there, and people are we tend to be wedded to the systems we know. So for instance, let's say on the credit scoring side, you will see people using SAS. On econometrics, they might still be using SPSS. People are using certain systems, and therefore the adoption of those languages which are more uh, important for adoption of AI and ML in an enterprise, we might see slow offtake there. The fourth part is the perceived risk. As I said, each of these algorithms bring new set of challenges with them. And it is very important that those risks are at least identified, if not managed. And the last is very enterprise specific. It is possible that ML or adoption of AI is not a management priority, and we might see slow adoption for certain enterprises simply because of lack of strategic intent. Vipur, next slide, please. Let me finish my part by speaking about how to adopt AI ML in a particular enterprise. I'm just taking an illustrative use case of credit scoring, and I'm assuming that today the enterprise is not using any model. They are using, let's say, judgment-based model, or they are using some models which are based on traditional algorithm. So, what we typically would recommend is that you adopt a maturity model where you do a current state assessment. You find out where you are, what are you identify the gaps in your entire pipeline today. And the second part is the key part. Once you know what is the data set that you have and what is the data set that you need, uh, make sure that you do proper feature engineering on that input data, and you are able to build feature library or a characteristic library on top of that. So if you have the right type of data flowing in, it is very important that uh, you bring out as much information that particular data carries. So for instance, as I said earlier, borrower interconnectedness, it is still being ignored in the industry, even though the data for that is flowing into the system. How do we identify those variable interaction, and how are we able to store it in the system becomes very important. The third part is start easy. Start with some kind of analytics, which might be a simple MIS, which is actually aiding you in business decision making. So the entire exercise need not start with building a statistical model. It might be some simple MIS coming from the features that you have created. And if the management sees value in that, then the journey for strategic involvement of management in actual adoption of AI or ML, that involvement would improve. So start small, start with multiple analytical MIS, and then go to the next stage, which is actual model building. Therefore, what we see is typically the models would continue to be built using combination of data. On the algorithm side, what we might see is that the industry, as far as traditional banks are concerned, they might still stick to the algorithms in which they have expertise, for instance, logistic regression. But the alternate algorithms might be deriving more of the challenger models. Okay, so these models would be used as benchmark, as performance benchmarks. As far as fintechs are concerned, what we would see is that they would largely discard the traditional way of doing things, and they would simply jump up to the algorithm which gives them best performance on that particular data set. So we might see a combination of champion plus challenger being run by different algorithms, traditional versus advanced, and as far as banks are concerned. And on the fintechs, we would see that there are challenger as well as champion model, all built using advanced algorithm. The last pieces would be setting up a practice for periodic monitoring, so that you know and you can identify when to identify issues with the kind of inference the model is giving on real-time data, and when is the right time to revisit the model. And the last part would obviously be able to derive business insight and business benefits from the entire exercise. It should not be an exercise in terms of building models only. Finally, at the end of it, the enterprise has to derive business value out of it. So if I have to piece the entire maturity model, it would be starting from identifying the data that you need, uh, deriving information from that data, making simple MIS and analytics flowing from that data, building predictive model, monitoring those models, and lastly, deriving business benefit out of this entire exercise. So with that, I also conclude, and we all would be happy to take your queries on this. Thank you.
Thanks, Dinesh. Thanks, Nitin, Neha. I think you guys have given phenomenal insights. We are left with less than expected time for Q&A, but we'll try to cover as much as we can. So quickly, there are a few questions. I mean, there are a lot of questions, to be honest, but I'll take first come first serve basis. So Mr. Safdar Hussain have a couple of questions he's been posting to us, and one question which is addressed to me: how about skill shortage as a challenge? I think Dinesh has covered in the specific context, but yes, it is one of the biggest challenge, because first time I would say. In recent years, where banking is competing for skills with more serious competitors. So tech firms, fintechs, firms across the sectors, and so it is a big challenge for banks to attract and retain the talents. And what banks are doing about it, they are doing quite unconventional things which I never thought banks would do. And just to give you a personal example, one of the top 3 US bank, which is our client, and when I was asked to meet their data scientist team, and I walked into their office, for a moment I thought I am in the wrong office, because there was nobody in the suit. People were moving around in Bermudas and t-shirts, and this is a tier 1 high street bank. So yeah, banks are rapidly adopting, because if they have to compete with likes of Facebook, Google's, or Amazon, you often cannot expect this talent to come in a suit and work in a bank. So banks are doing changing themselves to become more attractive, not only purely from the compensation point of view, but also from the work culture, work empowerment point of view. So that is, and there's a message here that it's not only about compensation, it's about culture, work environment, and bank has to cover a lot in this regard. So the second question, Neha, directed to you regarding credit scoring. How can we get alternate data? I've seen telco providers don't provide user level data only, they provide aggregate data. So any thoughts, experience you might like to share with Mr. Hussain here?
So Sabdar, the alternate data search is basically you search far and wide. Some of it is available in the Android app that you have. Right from the click through data, how much time person is spending on what screen, how much time he's spending on filling up the addresses. Is he changing his thing again? You have options of sliders. Is he changing the options? So this is something that you can do, that you can pick up in-house when you have an app. Then you have external alternate data like Android data, which you can work with your Android team and get it through the app. Then you have third parties, like you said, telcos. So telcos typically would require you to commit a very large sum for you to be able to access their raw data, right? So that is why when you say that you have to go through a third party. So third party typically would tie up with the telcos, and then uh, the third party would provide you the features and or the score typically.
Okay. So next questions, Dinesh, for you. How do we see reinforcement learning used in banking finance? Do you have any use case on this type of learning?
So typically, we are not envisaging use of reinforcement learning as far as lending is concerned, but I'm not the expert on that side, but it is possible that we might see use of reinforcement learning as far as trading is concerned. Okay, so as far as algorithmic trading is concerned, which are the algorithm which are bringing good returns for me, and how do we optimize our existing portfolio. So that is one area. Basically on the investment side, you might see as far as investment portfolios of banks are concerned, they might start using reinforcement learning. But as far as on the lending side is concerned, no, I don't see any use case right now.
Thanks, Dinesh. Nitin, I think because you're doing it on a daily basis, I'll direct the next question to you. How do you prioritize use cases?
See, prioritization of use cases always bases the business need. I think even if I don't talk about machine learning, overall, I think what impacts the business the most is prioritized first. Now, talking about machine learning, for example, if I have a use case which would help me in terms of minimizing the risk or the fraud, the transactional fraud uh, that might occur on the platforms, that would always be given highest priority because it would save us a lot of damage that can be caused. So I think in terms of detection of fraud, etc., whatever, I mean, in terms of maximum impact that a particular use case can have on the business, either in terms of protecting your uh, money or in protecting your intellectual property, that always takes the first priority. And in terms of second things, like if you look at new opportunities which can actually drive additional revenue, that comes the next. This is how typically we do it.
Okay. Nitin, while you're on, one more questions because you've seen both side of the world. Um, what can banks do to catch up with fintech? I mean, and do they need to catch up or they need to work together?
See, I think I'm a strong believer of having a partnership with the banks, because while fintechs would be very agile in terms of how they build what they build, but at the end of the day, fintechs, to deploy money, they need capital, and that's where the banks have most strength in terms of providing that capital that you need. Now, the other challenge that I see on the banking side is these a lot of regulations. We have interacted with a lot of banks, and what we have understood is a lot of their time actually goes out in regulatory requirements. So a large part of their teams are also working on, whenever they're looking at a new business model, they have to take into account a lot of regulatory requirements. On a daily basis also, they have to work on a lot of regulatory things. So I think it would be a really good partnership, rather than, I think we have never seen banks as our competitors. We have always seen them as our partners, and today also we have about dozen banks who have partnered with us and who have been funding a lot of dealers and suppliers on the platform. So I think looks to me that it's going to be a partnership rather than being something like that the banks have to catch up. I don't think they should worry too much about in terms of creating more machine learning models or spending a lot on the machine learning. Rather than, I think partnering with fintechs is going to be a faster route for them.
Yes, that's I think what's happening globally. I think let me pick the next few questions. There's a question about the regulatory requirements for deployment of these models in banking and fintech space. So there are number of you know guidance published globally, including if you look at the updated guidance from Federal Reserve in the US, which have updated their SR 11.7 guidance with adoption of AI machine learning models. Monetary Authority of Singapore has published guidelines. The European Banking Association (PRA) here has published guidelines. Obviously, as I mentioned earlier, that while regulators, or the regulations are not seen as a major hurdle, but regulators are still not giving a clear direction in terms of the adoption. But broadly, what we are seeing among the client is regulatory models is still, so regulatory models such as your loss computation model for IFRS 9, CCL, or regulatory capital are still largely remaining in the traditional domain, and banks are using ML models just to create challenger benchmarks. But in the non-regulatory space, for underwriting and a lot of other use cases, what we discussed today, banks are rapidly adopting the ML model. So this, two-world phenomena will continue for some time till regulators are comfortable with the explainability and ethical aspects of AI in terms of bias. So that's on the regulatory adoption. And last question, given the challenges adoption of AML, what pace of adoption can we envision in Indian banks and NBFC? Which uses cases would see higher priority and quicker adoption? As Nitin rightly said, I think the priority here has to be specific to an institution's need, and probably it would make more sense to pick where you get the more bucks for your investment. So the business case would drive it. So mass adoption, we have seen certain clear trends in terms of onboarding customer, KYC, frauds, AML. That there we are seeing mass adoption, but it would continue to be driven by, I think, a bank's ability to differentiate themselves ahead of the curve. And that should be the priority. What can differentiate and generate most business return for you? That's where you should focus on. So with that, gentlemen, we'd like to conclude this session. Thank you very much for your time today. I hope you found this useful. Like all our series, we will continue this series also with follow-up webinars and inviting experts all across the world to share their experience. And we'll be happy to answer more questions. You can directly send this to us. We'll share it with our fellow panelists, seek their answers, share with you. And also, we will be sharing the recording of this webinar with all of you and the copy of presentations, some of the presentations. So thank you very much again. We greatly appreciate your participation and making this webinar a big success. Thank you.
You.
Right.
Hello.